Thank you for sharing your Wednesday night with me. It is AfroEconomics Live, and I am Bryan, the president and the creator of AfroEconomics and the president of Bryan Financial Group, a registered investment advisory firm and the home of AfroEconomics, established in 1995 when I was very, very young. Don't let that age me. So, let's talk tonight about 3 important factors of our financial life: strategy, diversification, consistency. 3 important things that we need to be considering when we think about our money, right? And make sure, those of you who are hanging out with me in the webinar, I'm going to make a conscious effort to look at your comments, look at your questions during our time. And so that if you have any points, please put that in there. Make sure you put, that's the power behind participating in the webinar. So everybody that's not, if you're on social media watching this on the AfroEconomics with Bryan page, that is the only place that I put it. YouTube, they get it later. So make sure that you take advantage of just putting the comments in, and the team is watching you and they will be able to respond or make sure that we get connected to get your reply. So let's check out, I'm going to pull out my notes on diversification. So we're talking about diversification, strategy, consistency. And diversification is really a risk management strategy. Because if we weren't caring about risk, we really wouldn't diversify. Because if we weren't to just make all the money possible, we might say, well, I know this one thing is going to work and I'm going to put everything I have in that one thing, or that one investment, or that one company, or that one idea. I'm going to put everything into it, and that could work, but that's a lot of risk, because what if that doesn't work, right? And when I think about diversification, sometimes it makes me think about my history. When I think about the insurance companies that used to insure slave ships, and they would put the slaves on different ships because they were trying to diversify their product. My ancestors, they would diversify because that was their asset. So they said, one ship goes down, then I will have other ships. So the insurance companies that would actually insure those ships would give them most likely the responsibility to make sure that you divide them up so you don't have so much exposure into that one ship. Well, that was diversification. Diversifying now is with our investments. We have to, realize that we need to take that same thought pattern, that if I divide across different risk levels of my investments, that I'm reducing my risk, but you're also reducing your opportunity to make, if there's one that really does extremely well, one investment in your portfolio, that one stock, say, or that one exchange traded fund, or that one mutual fund that does really well, then you're not going to have it all in there because we diversified. So asset allocation is the next step of diversification. Like, asset allocation is what makes diversification beautiful, because you can diversify but still have all your money in the same asset class. You can be diversified but have all your money in stocks. So when we truly want to reduce our risk, we'll take diversification to a higher level, and we will cover asset allocation, which is a type of diversification, but you are diversifying across asset classes. So asset allocation is seen as one of the most important decisions that an investor can make. The selection of the individual securities within the asset classes becomes secondary, because it comes down to what percentage do you want to have in stocks? What percentage of your portfolio do you want to have in bonds? What percentage of your portfolio do you want to have in cash equivalents? And then within that 70%, you might say you want in stocks. Then you might say, I want technology stocks. I want real estate stocks. I want, different medical stocks. I want different types, retail stocks. What types of that? That's diversifying within it. But the pure asset class is seen to your asset classes that you choose has been seen to have the greatest impact on your investment return. Because if you choose to have 90% of your investment portfolio in cash equivalents and only 10% in stocks, or 5% in stocks and 5% in bonds, then you're going to have a different long-term return based on historical performance. You're not going to perform as well historically as a person who had 90% in stocks and 5% in bonds, 5% in cash, right? So definitely the asset allocation in that example, based on historical performance, you can see the difference, and that person with that stock portfolio will have done better than the person that just sat it in on cash based on historical performance, which is no guarantee of the future. So we might be heading into a future where cash or cash equivalents or money market savings accounts outperform the stock market. Anything is possible. Is it probable? So your asset allocation, I'm able to determine based on your specific risk level that you say you're most comfortable with. So these are some ideas on diversification. Now we just talked about like diversification, including asset allocation, and you look at diversification. And then just some tips for diversification. Commit to building a portfolio, making sure that you do diversify across the asset classes. And then add to those investments on a regular basis. Know when it's time to get out. At the beginning, decide, am I going to give this 5 years, this portfolio? And it's a lot easier to give a portfolio 5 years, 10 years, 20 years to a portfolio than it is to an individual stock. So how you set that committing to building a portfolio is committing to being diversified and understanding your risk tolerance. It's all going to come into play. So you have to know when you want to get out. Know when this is enough for you. Know that. And then when you have a portfolio, watch your expenses in the portfolio. Watch how much the investments that you have in are costing you, just internally in the expenses. I've been fortunate in that unfortunately, it's too easy. It's just way too easy to beat out other products because their expenses are so high. So I can just look at a client or a member's portfolio and help them increase their long-term performance potential just based on getting them out of these expensive investments that they're in. But we have to put ourselves into a position. We have to be in the right areas to actually be around a situation where you have someone that and that's how powerful you can make your membership in AfroEconomics, putting yourself into a place where you actually are getting to know your portfolio. It's not all about like, I got to get rid of what I have. If what you have is great, it's good to know that what you have is great. But put yourself into a position, at least, at minimum, ask your current financial advisor, what are the internal expenses in what I have so that you know? Or there's databases or there's information online. You can get this stuff. I have it at my fingertips. I pay for these things to have that type of access to it. So you can get that information. And let's look at a second component, strategy. Strategy. Key things there I want you to think about is when you develop your financial strategy, it starts with having a financial plan and a risk analysis, having an understanding of your risk. And then take that financial plan. You've got this clear look of what assets you have, what bills you have, what your risk tolerance is, the risk level that you're exposed to in your existing portfolio. You can do all that. And then determine where you are from that. Like, I have enough money to live off for the rest of my life, or I have enough money to live off till next week, or I have, I'm early in my career and I need to start accumulating more money, and this is how I'm going to do it. And define what must come first for you in your portfolio. Some of you, it may be that you want to skip to a portfolio, but you have extreme amounts of credit card debt. And the fact is that debt, getting rid of that debt is a great investment, and that is a guaranteed return on your money on getting rid of high interest rate debts. Take action. That's because once you get rid of that debt, you can save more. Take action, do it, and have an accountability partner. Again, and I'm just saying that is consistent. It's consistent. You went and said, looked up, just Googled how to be successful in life. It will say, have a mentor, have someone you work with, have a role model, have a developer. That's AfroEconomics. Even the no excuses, no charge, #priceless membership is an accountability partner for you. When we have our consistent meetings, I promise, which takes us to the next point, to be consistent for you. I have had this business committed to developing wealth in the Black community since 1995. I deserve to be called consistent, right? Can I get an amen? So you have to also have a consistent mindset for wealth development. Consistency, this is our point here. Having a consistent mindset for wealth development. Then create specific and realistic financial goals. Consistency. And then forgive yourself for whatever has gone wrong and keep on going. Now, we're talking about key things that are vital for your financial success. I mean, like, why, JB? Why would it be, important that I forgive myself? Because it's hard to be consistent when all you're thinking about is what I did wrong, and you're just like, I got all these bills. I'm not saving enough in my 401k. I don't have a job. Whatever it is, you got to move forward from that so that you can be consistent and you can do these things that I'm suggesting. So you have to hold yourself accountable again for being consistent. Now, here's a secret. No, I don't know if I've mentioned this in diversification. I probably didn't, but I want to talk a little bit about dollar cost averaging, because when I think about dollar cost averaging, it is the key example when it comes to investing of consistency. Dollar cost averaging is a common investment strategy where you invest the same amount of money each month. And that's what a lot of you are doing through your work plan, through your own individual retirement accounts. That dollar cost averaging is where you invest the same amount of money in set intervals. It takes like you worrying or obsessing about how the market is doing or when I should invest. It takes the guesswork out of it. And don't need to worry about when's the best time to get in the market. You're just constantly going into the market in hopes that it will allow you to reduce your average cost. So it's average dollar cost averaging. So if you put in $500 a month in January, and you putting it into, say, an exchange traded fund or some fund at work, or the TSP if you're federal, and and it might be $33 per share in January. So your $500 buys you like 15 shares. And then in February, that same investment may be at $35 a share. And you put in $500. So that $500 at $35 a share gets you about 14 shares. So then it might be some months later in July, say it's at $29 a share. You're putting in your $500 a share, $500 a month. You get 17 instead of that 14 and 15. Because the market went down, you're able to accumulate even more. And that's why sometimes, I try to encourage the members and clients that the market being down is a great opportunity when you are investing, even just reinvesting your dividends, because your dividends that are constantly being reinvested from your investments will be buying additional shares when the market is down and buying additional shares when the market is up. But that dollar cost averaging allows you to take advantage of a down market. You get more for the same amount of money. Like going into the mall and you got $500, everything on sale, you get more clothes, right? Everything at full price, you get less clothes. Well, dollar cost averaging is the way to approach the market that as well. Also, and it makes it more affordable. It makes it easier. Some people don't have like $6,000 to put into their IRA at one time, but they may have $500 a month that they can put away into their Roth IRA or their traditional IRA. So don't sleep on what you can do. You must do. You have to do that. So the dollar cost averaging example is an example of having a strategy, being consistent. And if you're going into a fund of some sort, in that you are also diversifying and could be building up into different asset classes, because part of that money could be going into a stock fund, it could be going to a bond fund, and part of it could be going into your money market. So the dollar cost averaging still can be helping you build an overall well-diversified, good asset allocation portfolio. So these are our key ways that just some key thoughts, but this is only 3. Like I could expand it could be like 25 important factors in your financial life, but this is a good basis. Strategy, having a strategy, how you're going to get this thing done, getting that plan together, diversifying, spreading your money out across asset classes, understanding asset allocation. That's what I do. And being consistent about your commitment to developing wealth and your consistency about making sure that you're investing regularly during your accumulation phase of your life. Right? There's the accumulation phase, and then there's the withdrawal phase, right? So during the accumulation phase, make sure you're taking advantage of good asset allocation along the way. During the years where you have time for your money to grow, take advantage of developing and learning more about a well-diversified growth portfolio. I have the asset allocation, I have the AfroEconomics growth portfolio, aggressive growth portfolio. I have the AfroEconomics Sankofa portfolio, the AfroEconomics World portfolio. All of it is based on your risk tolerance, and it automatically matches you to the appropriate portfolio for you. You can do that automatically by visiting the website, or you can make sure that we talk. And then after you join, we do the risk analysis, and it matches you up with the appropriate portfolio. We look at it. We look at what you got in it. What are your top 10 equity holdings, your bond holdings, what you got in there. And that's why the regular meetings are so important. Let's stay on it. Y'all make sure you ask me if you have any questions about any of this stuff that we talked about. How you doing? How are you? Y'all are just, I'm so glad. How are you doing, Mr. Barry? Good to see you. Good to see you. How you doing, Ms. Jones? To everyone that's on the telephone, I see you. Thank you for using the call in. Look, I see you. You can't see me, unfortunately. How you doing? Oh, Miss Jones waved at me. Yes, indeed. How you doing, Miss Hargrove? I'll see you soon. Thought I was going to see you tomorrow. I got the news. How you doing? How are you doing, Mr. Scott? Yes, we got people all over the country. Y'all are fabulous. Y'all are fabulous. We got New York. We got California. We got Virginia. We have Maryland. Y'all are a blessing. Any questions, don't hesitate to contact me. See this recording on the YouTube channel. Please subscribe. Please take advantage of the absolutely complimentary, no excuse membership for AfroEconomics. Look at that, y'all. AfroEconomics salutes the 10th principle, Black Health, Black Wealth. Register for that. That's September 14th in Virginia. And we're going to have fitness instructors there, yoga people there, line dancing. We're going to do half the day of information on wealth development and what's important for us and most importantly, it's about health and moving. I want it to be a fun day. I want it to be something different than what I've ever done. I'll see you soon, Ms. Cotman. Thank you. Thank you. Y'all have a wonderful night. How are you, Ms. Wright? Good to see you. Y'all have a wonderful night. I'll see you Friday morning, members. Be accountable. And I want everybody to be a member. Tell your friends, no excuses. We can all get our wealth right. Love y'all. Have a good one. Yes, indeed. Thank you.